Franchise group Famous Brands reported robust interim results with a 9% increase in interim headline earnings per share to 125 cents. Revenue for the 6 months ended August rose 12%. The group implemented a deliberate pricing strategy to stimulate sales and protect franchise margins. The company's CEO Kevin Hedderwick now joins me to unpack those numbers further. Kevin, great to have you in studio. Thank you so very much for joining us. Let's touch on your UK operations, and I think that was one of the biggest headlines that actually hit today, that you are now going to put on the back foot the opening of the Steers brand in the UK market, given the fact that there is just so much trouble within this UK environment. But that said, your trading conditions within that period, we saw revenue declining in your existing operations. Is there more trouble ahead?
It's a tough place to trade. I think we keep saying that, and having been there 3 weeks ago, it doesn't look like it's going to get any better. But I'm at pains to point out, though, that even though it's not an easy place to be trading right now, I mean, it doesn't distract from our focus on our home market. And we're doing all the right things, and I think it's just a question of timing. I think that it will turn, and when it turns, we'll be well positioned.
It's interesting because your operating margin actually increased over that period in the UK to 8.4% from 7.4%. Tell us a bit more about that.
Well, I think we've been very astute about how we manage the costs over there in a declining economy. That's what's helped.
Let's touch on all the acquisitions over the last period and how you've bedded those acquisitions down.
Work in progress very much is Milky Lane, complete relook, new format, and we hope that it will be emerging in the South African consumers' eyes in the summer season. Then we've done some fantastic work with the Cake Pub brand. Unfortunately, that's been stalled a bit in terms of taking to market by virtue of the fact that the Gauteng government have put a hold on all liquor licenses, which is a bit of a problem for us. And then Jeramundo, our flame grilled chicken brand, still very quietly confident about that. Consumer response has been very positive. What slowed our growth down a little there is that because we're a small brand at this point in time, is that we don't have a lot of landlords and developers that are actually chasing us for sites. So we've changed the strategy a bit now. We're going to our existing franchisees who might have some spare retail space and doing a store within a store with Jeramundo, and that's working very well.
How are sales doing in that space? We know that the chicken industry is very competitive at this point. Are you still finding that sales and that there is appetite for this new chicken offering?
Oh, there absolutely is. I mean, chicken as a category in South Africa is huge and continues to grow, so we're riding on the back of that growth.
A rollout of 90 new restaurants planned going forward. Quite a big number, because over the last period you opened up 50 new restaurants. It's funny because in your prospects you talk about a cautious environment going forward, but here you are opening up new stores. Tell us about your strategy.
The development has been slow in the first 6 months, and that's really been because there's been a slowdown in development by the property market. But certainly everybody wants to open as usual again before December in the summer season. So as you've pointed out, a very, very busy time for us now. We want to open 90 restaurants between now and February, and then another 30 outside of South Africa. So we're opening literally 24 restaurants a month now.
Logistics division, also interesting that you've embarked on a new strategy there where you've got the owner-driver pilot program, which is currently underway. You've got 11 owner-drivers, and you plan to have 19 by the end of the financial year. How is this working to your benefit?
It's worked exceptionally well, not just for our benefit, but also for the guys that have gone on as owner-drivers. The owner-driver model is phenomenal in terms of productivity and efficiencies. And what we're seeing in a place like KZN when we pioneered this model is that we've seen a 50% improvement in productivity and efficiencies. And so what that will enable us to do in the longer term is certainly control our capex spend on logistics fleet. And what we're doing at the same time, of course, is a fantastic BEE initiative, because we're putting drivers of our own into business on their own.
The manufacturing division, we saw revenue increasing by 6%, operating profit, however, down by 2%. Do you expect a turnaround going forward?
Oh, yeah, we absolutely do. The next 6 months we hope to claw some of that back.
How do you plan to do that, Kevin?
Well, we're going to have to put through price increases, which we've held back on for the first 6 months of this particular year. We've done that deliberately to keep the prices down to the consumer at the retail end. Unfortunately, though, the price of red meat has rocketed so much now that we have no option but to put a price increase through in November.
And you've been absorbing that for quite some time, the increase in the meat prices?
Up to now we have, yes.
With regards to your expansion further into Africa, we know that you are looking at Zambia, Mauritius as well. The rest of the African continent looks really lucrative. Tell us about the space that you're going to go into, because obviously it's going to be quite costly to open up new stores there. Are you going to be able to pass on those prices to the consumer, or is it going to be relatively similar to what we see here in South Africa?
Well, in Africa we trade a little differently in that we trade through a master license arrangement. So we find somebody that's an entrepreneur within that country who does what we do in South Africa, and we share the revenue stream and the income. From an Africa point of view, we're doing some fantastic work in Zambia, where we're going to double our footprint, and then also in Mauritius. And I suppose, like most food companies, we're cautiously eyeing Nigeria as well at the moment, although we have a presence there with 3 Debonairs pizza stores, and they're doing phenomenally well. How
competitive is the space right now? And of course, you were also alluding to the fact in your results that we're starting to see competition being quite adopting interesting strategies with regards to trying to push turnover, reweighting the meat portions, and then changing prices to suit certain elements. Are you embarking on a similar strategy, and is it just becoming far more competitive out there?
Yeah, I've seldom seen the marketplace so competitive as right now, and what we do see is some operators doing some strange things, like guys who in the seafood business opening early in the morning for breakfast, as an example, which is quite unique.
Seafood for breakfast, that's
which is quite unique and strange. But price has become a big component, and we've also done something similar in terms of the Steers brand in particular, where what we haven't done is cut pricing, but what we have done is provided the marketplace with a smaller burger offering at a relatively lower price. So it's the same Steers product, but at a lower entry-level cost.
Fantastic, Kevin. Thank you so much. We have to leave it there. Great to have you in studio. Kevin Hedderwick, the CEO of Famous Brands.